Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Welcome to the Risk Intel podcast. I'm Ed Vincent, and with me today from Davis Wright Tremaine are Alexandra, Barrage, and Ryan Richardson. Alex and Ryan, thanks for joining us today.
Thanks for having us.
You guys have crossed paths before your days at Davis Wright Tremaine, working at the FDIC. And I know you worked closely and consulted on the third-party guidance proposal there that we're going to spend some time talking about here today. Alex, you're a partner at Davis Wright Tremaine's Washington, D.C. office and have significant experience working with supervisory teams within the largest banks. Ryan, you followed a little bit of a different path, right, before joining the New York office of Davis Wright Tremaine, working on the FinTech side, right, working at Stripe as the lead partnership lawyer, and have experience looking at this from that perspective inside of FinTech itself. And I know that both of you work with banks and FinTechs today, and we're really excited to hear a bit about that experience and your thoughts on what's going on in the market today. So thanks again for being with us. Let's jump right into it here. Right, we've obviously have had an exciting set of developments here over the last couple of months in the FinTech space, to say the least. So, can you kind of take us back here to early June when the final guidance was released by the OCC, the Fed, and the FDIC, and give us some perspective on what transpired in that period when the preliminary guidance was released, and you guys were doing some of your consulting work there. And then the final guidance that came out. So, what was new? What was eye-opening there in that set of guidance that came out in June? And Alex, maybe you can start, and then Ryan, perhaps coming on the back of that.
Yeah, sure. Look, I think it's great to start with kind of the recent history of the guidance. I like that frame, and I would say, several years ago, the guidance was put out for comment. There was so much robust comment from all different parts of the FinTech and other third-party, ecosystem, along with banks themselves, that the regulators had to actually extend the comment period. That said, this proposal was kind of sitting out there for quite a while. I think probably more than two years. Folks were expecting it to be finalized end of last year. It didn't happen, and so when it finally was issued, a few weeks ago, or more than a month ago, actually. In some ways, it was quite a big deal, right? Because it had been kind of out there for a while.
Anticipated, right?
Yeah, exactly. In other respects, it was not altogether different from what we saw in the original proposal. Some interesting kind of nuances in the final guidance were that, the key points are the same. Banks are ultimately responsible for conducting their activities with a third party in a safe and sound manner. And the agencies expect them to adopt risk management practices that are commensurate with the risk that these third party relationships pose. So that was all the same. OCC FAQs were basically incorporated in the final guidance. And one of the most important things about the guidance is it's intended to be a one-stop shop. There aren't other guidances out there that folks need to read. This is really the kind of document that guides it going forward. The specific focus on FinTech partnerships, or what the final guidance calls new and novel structures, I think is notable. Just over the past, 5-10 years, we've seen a proliferation of third-party relationships in banks, and I know that's something near and dear to Ryan and his work. The guidance is technically not a binding regulation. It does not have the force and effect of law, so the final guidance actually makes that very explicit. That said, I think banks treat it as if it were binding, just like any other guidance document. Supervisors use the guidance as a basis for examination inquiries. And so effectively, the industry takes it quite seriously, as do, of course, the regulators. And I think the third point that stood out in terms of the original and the final was just the importance the guidance plays on the role of the board of the bank. And so ultimately, the final guidance talks about the responsibilities of boards of directors in terms of providing oversight over a bank's third-party risk management, providing guidance on, acceptable risk appetite, and making sure that the appropriate policies and procedures are established and implemented. So the role of the board and kind of overseeing all this activity, I think, is something that stood out when I did a compare between the two. Let me give it over to Ryan for his thoughts.
Yeah, no, I think all of that's exactly right, Alex. And I think another sort of aspect of the final guidance that stood out to me by comparison to the proposed guidance was just a sort of additional emphasis in the language, honestly, section by section, of the fact that this is a principles-based approach, right? And I think that was clear in the proposed guidance as well, but there's a significant additional language added to sort of re-emphasize that point by point. And I think that also threads through some of the decisions that were made with respect to incorporating some of the OCC FAQs. Some of the OCC FAQs that the agencies decided not to incorporate actually sort of were factual specific or industry specific, and it was clear to me, at least, that one of the sort of themes that the agencies were going for in the FAQs that they did choose to incorporate were those that were principles based. So like they're really hammering that this is not, this is not industry specific. This is not particular, one type of relationship or another specific, but it is intended to be a set of principles to guide evaluation and operation and risk management of third-party relationships sort of enterprise-wide. That I think is it's certainly understandable and reasonable approach. I think it is also understandably occasionally frustrating to those industry participants and commenters that were looking for factual specific guidance on how to evaluate risk, act on risk in one particular set of facts or another. But the approach that the agencies ultimately took was to try to make this as flexible as possible across the broad range of types of third-party relationships that banks may enter into, whether with vendors, FinTechs, et cetera.
Ryan, do you think that does that concept of making it a bit more principles based, does that make it? This might not be a fair question, but does that make it harder or easier on the bank or the FinTech to figure out what to do now?
Yeah. I think it's both, right? I think it's easier because you can always fall back on a set of principles, right? Like sort of fall back on first principles as you would in any, I think, sort of critical decision making in this area. So, always being able to rely on a set of uniform, well-established principles as guides for your factual specific or fact-specific decision making, I think it's simple and elegant, and I think in a really nice way, and it provides a clear anchor for decision makers on risk committees, at the board of directors level, et cetera. It's sort of a common vocabulary and a common set of criteria, if you will, to follow in any sort of risk-based decision making. That said, there is very little in way of any sort of factual specific guidance, right? And so what it means is that banks, FinTechs, market participants across the spectrum are having to do their own work of applying these principles, right? Like actually sort of operationalizing them on a day-to-day basis. And that is challenging. So, it does present a certain set of challenges, but it also, I think from the regulator's perspective, and curious for Alex's view here too, I think that simplicity and elegance is very appealing, right? That like you can use the same document to look at a cloud services vendor relationship as you would at a FinTech relationship, as you would at a physical goods relationship on a service provider basis. So it is sort of easier to apply and to maintain from a regulatory perspective.
Yeah, so I agree with what Ryan has said. I think the nuance for me is that while it is intentionally principles based, the potential frustration with that approach, as you said, Ryan, is just the vast universe of FinTech or third-party relationships, not just FinTech relationships. And, you know, the idea that like a consumer-facing FinTech bank relationship could raise very different risks from, let's say, a FinTech relationship that's more like a software as a service tool, like SRA, right? Like where there's a product that a bank is using for its own internal risk management. There's no consumer-facing dimension to that. And I mean, there are other flavors, I'm sure, of like if you were to kind of heat map these different types of arrangements. So while being principles-based can be helpful because you kind of have this like body of work around the different phases of the life cycle, I still think that there is a general frustration on behalf of regulators that they're not really able to see under the hood as much as they might want to, given the different risks that these different relationships could pose, and if not risk managed, the concern that it could potentially lead to real harm. And we've seen that with certain consent orders that we've reviewed just over the past year. So will we? Yeah.
No, sorry, finish the thought there.
As I say, I don't know that this is the end, this third-party risk management guidance. We hope to see more around risk management guidance for community banks.
Mm-hmm.
So that might be the next kind of phase of this work. But I think the general frustration is probably still out there. It's shared both by the industry, the banks, and probably also the regulators.
Right. Well, will the regulators behave any differently now, though, that given that we've now moved from the preliminary to the final, you know, does that indicate then a different type of behavior on their part?
So, I mean, I think in general, we're in a period now of pretty intense regulatory scrutiny on these kinds of relationships. Not every relationship, but certain ones, certainly the new and novel FinTech ones. I mean, that's straight out of the final guidance. So in some respects, I'm not sure that it's altogether different because I think that the message has been very clear across a variety of speeches, even the Cloud Treasury report that came out in February, that risks are out there with these types of relationships, and some banks are overly reliant on them. So to me, it's not like the final guidance is like this turning point. It's sort of a culmination of things that I think Ryan and I have seen over time in each of our practices. But I think what's different, one other point before I give it to Ryan, is that now the banks point to the final guidance and they tell their FinTechs, I need X, Y, Z. And they have this sort of maybe new gravitas around that because they have this guidance out there that says, you know, thou shalt proceed in a risk managed, safe and sound way. So that's potentially something different that we didn't see before. Ryan?
That was exactly it. You anticipated exactly what I was going to say, and I think in both in the exam context and just generally, you're seeing the agencies speak about this now in a manner that they would not speak about it while it was pending, right? And understandably that they would not speak about it while the proposed guidance was out and comments were under review, sort of apart from a couple of speeches here and there. But yes, staff is now able to speak about it in a more definitive way. But I mean, I think the tenor of supervision in the context of exams was already headed in this direction before the final guidance was finalized, and so I have not observed like a pivot as Alex rightly described it in terms of like exams that were underway at during the time that this was released, that like all of a sudden that we're working with an entirely new set of criteria that hasn't been the case.
Right. So it's been, as you said, you both said, right, it's been building gradually here, right? Market dynamics, right? The relationships that exist between the FinTechs and the banks, right? And then the regulatory guidance as well, kind of all those things progressing. Alex, you mentioned some of the things that you guys have seen whether it's the last few weeks or the last few months or over the last year, right? As the market has moved this direction, I'd be interested if and understanding, right, that you have client confidentiality that needs to be protected, but it would be interesting to hear any thoughts that perhaps Alex you have first, and then Ryan maybe you have as well, that you've seen go on between regulators and the banks now, given that this guidance has been coming into focus, given that the market has been moving this direction. Are there any observations, right? You talked about, consent orders there, right, Alex? Perhaps share some of your observations that have come out of those regulatory interactions that have been particularly notable.
Yeah, sure. I'll talk about more the bigger picture and the exam piece, and then maybe Ryan can touch on the enforcement piece, which has been happening at a pretty steady clip. Again, I think across the board, there has been much greater scrutiny on bank and fintech relationships through bank exams. To some extent, all our bank clients have touched this issue one way or another, because they all have these partnerships in some way, shape, or form. The specific emphasis that I think I've seen in my practice is on BSA AML compliance and ensuring that the bank maintains sufficient ongoing oversight over its third party. So, for example, we have multiple examples where, as a technical matter, the bank is the financial institution for BSA AML compliance purposes.
Yep.
But many banks outsource some of that function to their third party. And in theory, they have very clear delineations of roles and responsibilities, including, for example, the filing of SARs, which is sometimes done by a third party.
Yep.
Sometimes it's retained by the bank. And so each relationship has kind of like a different sort of calibration of responsibilities. And oftentimes, when those responsibilities are not clearly defined, you see cracks and you see gaps. And those gaps can lead to real significant issues without the appropriate oversight and the appropriate risk management and communication, et cetera. So if I had to pick one topic where I've seen the most focus, it's on BSA AML compliance, and that covers quite a range, everything from customer due diligence and things like that. So I think I've also, generally seen this oversight issue come up almost every time in a bank exam or when a bank is speaking to its fintech. So those are the themes that I think have been most prominent. Ryan, what are you seeing?
I think that's exactly right. And I think that then a related thread that you see through many of the public enforcement and consent orders has to do with sort of the sort of day-to-day mechanics of that oversight, and in particular, like, what does monitoring actually look like in this context with respect to any function, including BSA AML? And so, like, is that sort of and I think the contract that governs a relationship, a third-party relationship with a fintech included, can actually lay out the role. The roles can be muddy or the roles can be clear. Even when they're clear, if sort of the information that's being delivered to a bank on a daily basis or periodic, daily, weekly, quarterly, whatever, is not being then digested by that bank in a way that actually allows them to get a clear picture of the risk presented by the relationship, identify potential enhanced risks or even deficiencies on a regular basis, and then try to remediate those in a way that is sort of prompt and effective, then, like, the rights in the contract are sort of useless, right? Like, the contract only gets you so far. And then I think what we've seen in many of the public enforcement actions is, well, so you may have been like sort of getting a data dump on even a daily basis, weekly, period, quarterly, whatever else. But what were you doing with that information? And how are you digesting it? What technology do you have in place to digest it, or is it a manual process or something in between? So I think one additional thread we've seen through the enforcement context is just all around monitoring and action on that monitoring. And I do agree with Alex 100% that a particular focus of that is in the AML space. I think you see a little bit of it as well in the fair lending space, in sort of credit risk generally. So AML and KYC, et cetera, have been a hot button for sure. But I think that monitoring piece threads across all different functional and risk areas.
Right, and the guidance, right, was very clear that the buck stops with the bank, right? And so, right, Alex, as you said before, you may choose to have your third-party partner perform some of those functions, but ultimately you need to have the controls, the checks, the balances, the oversight, right, the monitoring, and the bank has to ensure and is accountable for those things being in place, and that. From the fact that we do see these enforcement actions, clearly that message has not been universally grasped yet. And so there's still some more work to do, seemingly from an education perspective, to remind and reinforce that and drive that message home to the banks that the arm's length relationship doesn't mean that you can pass the buck in terms of accountability and responsibility there.
Yeah, and I think, speaking of arm's length relationships, we recently saw the American Express order where the OCC said that the bank's affiliate, which is basically their travel services company, that they didn't implement appropriate controls and mechanisms for tracking complaints, for example. So we shouldn't forget that it's not just the bank itself, the insured depository institution that could fall under this potential enforcement. It's actually affiliates of the bank. And so when we talk about monitoring and oversight, we really are talking about any operating entity within that broader banking institution as a potential focus.
Thank you for joining us today for this insightful discussion. The conversation with Alex and Ryan will continue in part 2, coming next week, where we'll dive into how banks can best comply with these regulations.